International SIPPs and double taxation treaties. Okay, this is a key thing we hear from our clients. I'm going to break it down for you today in a very short video. Okay, so a double taxation agreement is basically what one country has in place with another country to ensure that an individual is not double taxed. The UK is one of the most organized countries in the world for this and has over 100 double taxation agreements currently in place with other countries. This basically ticks off all the normal places that you may need to worry about if you're considering to move abroad as a UK resident. Now, when people say international SIPP and double taxation agreements, people are getting confused. Because if you watch any of my other videos, an international SIPP is a UK SIPP. There is no international SIPP. All UK SIPPs, all SIPPs and international SIPPs are FCA regulated and based in the UK. The term international SIPP doesn't mean it's a SIPP based in the Bahama Islands or it's a SIPP based in the Isle of Man. All SIPPs are UK based. So there's no difference between a UK SIPP double taxation agreement and an international SIPP double taxation agreement. It's the same thing because they're both under the UK government. Now, this would be different, for example, with a QROPS. A QROPS based in Malta, they have 69 double taxation agreements in place. There's a few odd scenarios where Malta does have a double taxation agreement and the UK doesn't. So someone residing outside the UK in one of those countries may prefer to have a Maltese QROP instead of an international SIPP or a UK SIPP. So I hope that explains the difference for you in terms of international SIPP, UK SIPP and QROPS. Now, the most important reason people want to have a double taxation agreement in place is for withdrawals. Now, if you have a UK SIPP and you want to complete your withdrawal, the UK government force the SIPP provider and the trustee to tax you at source at the SIPP because they're scared that if you take all the money, you'll never pay them the tax that's owed. So what if you have a double taxation agreement in place? It means the UK government won't tax or you won't be taxed in two places at the same time. However, if you're residing outside of the UK, you will need an NT tax code on file with your SIPP or your international SIPP in order for them to pay the payments out to you gross, which means a 100% rate. Inside our channel, we have other videos on obtaining an NT tax code. Take anywhere between 6 to 9 months. Once you have that on file, your UK SIPP or international SIPP will pay your withdrawals out gross. Now, a lot of UK SIPP providers simply won't allow you to apply an NT tax code because they're not interested in that. 99% of their clients live in the UK. Why bother with residents or non-UK clients? That's where international SIPPs come into play. It's still a UK SIPP, but it's catered for people living abroad, such as yourself, I assume, if you're watching this video. So you can have the NT tax code applied to your international SIPP. Then all withdrawals come to you 100%. You then go and declare them on your annual tax return in your country of residence, whether that be America, France, Germany, Switzerland, wherever it is. You then declare and pay your tax there. So that's the big difference. Double taxation agreement and international SIPPs is a bit of a red herring. It's the same basis as a UK. Now, other reasons you might want to utilize an international SIPP instead of a UK SIPP is purely from your address. The majority of good UK SIPPs do not accept non-UK residents. Why bother? 98 or 99% of their client bank is based in the UK. Why advertise and market to the 1 or 2% of people living offshore or internationally outside of the UK? Whilst an international SIPP is specifically designed, they still accept UK residents as well, but it's specifically designed to accept people who have a non-UK address, whether that be a proof of address from America, a proof of address from Europe, even a proof of address from the Middle East. You can still utilize an FCA regulated SIPP, but it will typically be called an international SIPP. Also, inside the international SIPP, you can use different currencies. Now, this might not always be advisable. Say you live in America, a lot of people might think, oh, I want to convert all my pension to US dollars and then I'll be safer like that. Not necessarily. If you have lots of assets already in the US, having a UK pension pot in GBP might be a good hedge against that. You never know what's going to happen in retirement. As the NHS starts to get more valuable to as you get older, you may well head home. So it's nice to have a nest egg in GBP. Guys, that's been my video today. I hope you found it useful. As always, you can get in touch with myself or one of our senior financial advisors. And please, guys, like and subscribe below. I know that only around 10% of the people who watch these videos are actually subscribed to the channel. So please subscribe and hit the like button to let YouTube know that we're doing a good job. And as always, take care with your UK pension assets.